It's October 16th, 2020, episode 101. I'm Kevin Muir. Patrick Ceresna is away again this week, but don't worry, we have Wall Street and Greenwich trading veteran Morris Sachs filling in. This week, we're pleased to welcome to the show Nick Givanovic, who shares with us the story of his career working in London for JPM and Salomon Brothers, then running his own hedge fund, and finally retiring to the Bahamas, where he is busy trading and saving the local animals. We then ditch our talking charts segments. Let's face it, I don't have a clue what I'm talking about in terms of technical analysis, and instead spend some time chatting with Morris about the hedge fund industry, fixed income trading throughout the decades, and ask the question, who was the biggest seller of volatility? We then end with Morris helping out with a new segment of No Stupid Questions and Skin in the Game, where Morris manages to stump me. And folks, we might even drink some beers along the way. So stick around, we got a great show. Lena, hop on. What beer are we drinking this week?
Today we're drinking Market Brewing Company's Bear Hug IPA. We've had this one before, but I think somebody really liked it. They didn't want to bring it back.
I think we did. Well, I'm drinking alone. To be honest, Lena is wimping out.
I can't drink today because I'm ill.
Under the weather. Lena is a real trooper, and she's not drinking with me, so I'm just drinking alone. So I went to the old favorite Market, the Bear Hug IPA. I really enjoy it.
So the Bear Hug IPA is a balanced IPA with big aromas of juicy pineapple, tangerine, and evergreen. Hazy and deep golden color, a bready and light caramel base is the foundation for assertive bitterness with citrusy and dank flavors. I remember this one. I think I kind of liked it.
Lena, you like all the beers.
That's true.
Okay, let me do the side effects. Nothing in the podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much Huddle may include United hair loss, swap pops, and the West Texas pumps.
Oh.
Let's get on to the main guest. It's our good fortune to welcome to the show Nick Givanovic. He's a former hedge fund trader that is now retired to the Bahamas and is a colorful character. I've been looking forward to this interview for some time. Nick, thanks for coming on.
Thank you very much for inviting me. This should be fun, I hope.
It should be fun. We've been chatting a little before we started, and I didn't actually know. I know the accent is British, but where did you grow up in Britain?
In London.
Oh, you did. You're a London, and
I'm not a Londoner, but I grew up in London. I went to school there, and spent a lot of time in London, and then I went to the West Country.
The West Country. Okay, so you go to school in London, and out of school, you get a job in the kind of heydays of Wall Street, or the city as it's known in London. You tell me you started at JP Morgan. Was that in London or New York?
No, I've always traded in London. It was my good fortune to do so. I found New York very, very hard to take. Much preferred London.
You know what? Actually, you can't say that without me learning why. What did you find New York hard to take versus the London?
It was so loud. I mean, it was a different level of intensity in New York. Those guys were just ready to kill their grandmother for 25 cents. It was just brutal out there. We were more gentlemanly, and and if a customer screwed us over, we took the rough with the smooth. In New York, that was not the case. Those guys were animals.
That's right. I always like the British sense of humor. Being a Canadian, we have a lot of British, and I love the British TV. I love their sense of humor and their sarcasm and their wit, and so I've always kind of preferred London as well. But you are correct that New York, they eat their young. It is a dog eat world. It's just
I had some very difficult times in New York. I mean, when you come up with an idea and you explain it to the higher ups and stuff like that, they just eat you alive, and they just don't let you finish. It's it was tough in New York. I didn't like it at all. I didn't spend that much time, although I did go there every week on the Concorde for about 6 months. I mean, it was brutal. yeah, I just absolutely hated it. But there you go. No, I mean, good luck to the guys in New York. If you can make it in New York, you can make it anywhere.
Right. Okay, so you get a job at JP Morgan in London. And I think
that's where I got offered a job out of university. Yeah, that's correct.
That's right. And so you spent some time there, and then you actually ended up at Salomon Brothers as well. Tell me a little bit about your early career, in finance.
Yeah, well, I was actually very fortunate to have a grounding in everything, because when you start at one of these big shops, they are very kind and considerate, and I mean, they're looking after their own money. But what they do is they let you spend a few weeks and trade each individual desk. So you start off with something simple like the telex. If you remember the telex machine, I don't suppose anybody who's listening.
No, we have some old
remembers the
telex
remember
machine. The telex, yeah.
But what that does, spending, say, 2 weeks on the telex machines, it makes you understand the plumbing of the of how the thing works, how to confirm a trade, what a confirmation means. These things are important later on, because it avoids you making mistakes. And then you go on to, position keeping and making sure the positions are right and the traders have got the right position. And then you step onto a desk and say you start off with the forwards in the FX, and you start understanding how the depots in one currency against another work and how it's reflected in the forwards. Then you move on to the spot desk. Then you move on to the dollar depots or something. You fund all the trades. And then finally, you go up the curve. You start trading 3 months. You go on, graduate onto 2 years, 5s, 10s, and then you finally let loose on the long bond. That kind of stuff. So but the most important thing is that they give you a really good grounding. You understand how all the pieces fit together. So later on, when you're in a big room like the trading room at Sally's, when somebody says, "Oh, sort of the forwards are moving," you know that the next wave is going to hit the depots, and you know that the short end is going to react, and then you know that sort of the curve might steepen, bull steepen or something. So you are aware of how everything fits together and why it fits together and what action you should take at that moment.
Okay. Do you know what I just realized as you were telling the story, and I was thinking about your timeline of starting in 83 and then going on to Salomon Brothers. Did you overlap with Michael Lewis at Salomon Brothers in London?
Yeah, he was there.
Oh, wow. So now were you on the bond desk at that time?
Yes, but he was a salesman.
That's right. And so you were with Lewis Ranieri, the mortgage backs.
Yeah, Ranieri, absolutely, yeah.
So you must have some great stories in terms of that was the golden age of mortgage-backed trading, was it not?
I guess. I never traded mortgages. Yes, they did a whole load of business with us doing swaps and stuff like that.
Okay, so you were trading you were in the swaps market as opposed to and what is that? Is sitting near the government guys? Is that what it would?
I was with the government guys. Yeah.
Okay.
And then after that, we sort of once you've had a grounding in absolutely everything, and you've even sort of specialized in an area I specialized in fixed income. Then after that, if you come up with some related ideas, they see whether you can move over to the prop desk and basically trade with the firm's capital rather than just position keep in bonds or whatever.
Right. Now, at this point, you were smart enough to go off on your own, and you joked and said this was when you could go off on your own and make your own hedge fund. Why don't you tell us about that story and how that worked?
Yeah, no, I had a bunch of customers after I spent something like 3 years on the prop desk. So I had a bunch of customers who liked my ideas, liked the way I traded. I guess they liked how I thought, and they gave me some seed capital. And because I always knew that I wanted to branch out on my own. You follow all these, mythical traders like Draco Miller or Paul Tudor Jones and people like that who were, the big swinging dicks at that time.
Right.
They weren't legends yet, but they, you could see that these guys knew what the hell they were doing just by looking at the returns. You didn't really need to do much else. I was fortunate enough that I could see some of the trades they were doing because there were, that information leaks very quickly. And, a couple of times I even tried to get in their way and learn my lesson very, very quickly. So I knew that was what I wanted to do because it gave you the freedom to basically choose your positions when you want to get in, rather than if you are even on a prop desk at a bank, there's some pressure for you to be constantly doing something.
Right.
Earning your money, meeting your quarterly targets, this, that. And that's not what I really wanted to do. I wanted to get in when I wanted to get in and not trade most of the time, but just when I thought something was mispriced or very, very interesting.
So you started in 91. You're still a young fellow at this point, are you not?
Yeah. In fact, I missed a step. I actually retired. I actually retired in 90.
Okay.
And because I thought I've got enough money, I'm never gonna spend all this kind of thing. That was my thought at the time. And within 2 months, I was so bored. I said, no, I'll ring all these guys and I will start the hedge fund. Oh, okay. So that's what I did. And and there we are. What can you do? Life is funny. And then for the next 10 years, that's what I did. I had very, very good success in the first 2 or 3 years, even 4. And then things started tailing off because I just could never, and I'm being totally honest, I just could never get used to trading billions the same way as I traded millions.
Okay.
I could just not bring myself to add that zero.
A lot of people think that's an easy. People think that's an easy skill, but it actually is really. It's difficult. Trading is not the same at different sizes.
Absolutely correct. Yeah. It's if you I think any good trader can make 50%, 100% on a million. Right. Now you do that on $1 billion, you are a legend. Right?
Exactly. That you're absolutely right. That's the difference. And you're right. And I think even Warren Buffett has talked about this, that he said, I would have a completely different portfolio if I was trading even 100 million, I would have a different portfolio.
Yes. And that's very, very true. I found it very easy to have very, very good returns. And I'm talking, 50% plus a year on 50 million, 70 million, 100 million. But I found it almost impossible to pull the trigger on an extra zero or two. Right. It just it's down to personality, how much people are afraid of the risk of the unknown. I knew that I could get out of 1,000 bonds in 4 ticks. Right. You try getting out of 10,000 bonds in 4 ticks. I mean, it's moved 4 ticks before you picked up the phone, because they know you're coming.
So it is a completely different game. Not only that, I guess this coincided with the time when a lot of the long-term capital, those relative value trades, were getting kind of squeezed to tighter margins until they eventually caused problems, right?
Yeah. No, the market definitely changed a lot in the 90s from the 80s. People, now think that it's changed a lot since then. I'm not really qualified to talk about that, but one thing that we didn't have back in the 80s at all was option skew.
Okay.
We had no skew at all. We actually created the skew, because we did a couple of trades which were so large that the market finally understands is that you cannot price puts and calls in the euro dollars at the same value, because the Fed is doing one thing: it's either easing or it's tightening.
Right.
And in those days, puts and calls, used to trade at the same price. And
So what, the skew was flat in those days? Like there was no smile at all?
Absolutely no smile, no skew, no nothing.
Wow.
Because really, in theory, the Black-Scholes model tells you that things are as likely to go up as they are to go down, right?
Right.
So really, you had to, when the option market started in the futures, the options on the futures, there was absolutely no difference between in price between a put and a call at the wings, none at all. And then people, started realizing that, my God, but the Fed is easing, therefore it's much more likely to go up than go down.
Right.
And you could literally fund your bullish position by selling puts. And you knew that the Fed just eased last week, where they're not going to tighten the week after.
Right.
So literally, you could have free trades, and we did such a large amount of those back in '86, when there was a big easing cycle which got reversed in '87, which brought about the crash. In '86, we just made so much money, and I'm talking a lot of money. And
who do you think was on the other side of your trades that weren't understanding the option pricing?
Well, it was all the other banks for a start.
Okay.
And the locals, or whoever was in the option pit at the time.
Right.
But you could do vast size. We did tens of thousands of those spreads. And basically, we funded the upside by selling puts. And so the thing would cost us either nothing, or we'd make 50 basis points if the Fed eased in the meantime. It was, that disappeared within months, because people realized what was happening. And,
they were mispricing the option market.
And basically the skew appeared.
Yeah.
And that was, and that's how.
So we can thank you guys.
I don't know whether you can thank me, but it was it was something.
Somebody was going to figure it out. Might as well be you and make some money.
Yeah. Well, whether it was me or whether it was the market all at the same time, and we were a little bit early, who knows? But it certainly was something to behold in those days. It was great fun trading. I mean, I looked forward to every day going to work.
And so you truck through long-term capital, you get through the dot-com bubble, and then finally in 2001 you decide to hang up the skates, as us Canadians like to say, and you close your hedge fund.
Mm-hmm.
And since then, tell us a little bit about what you've been doing. What happened? Where did you go? What's your life look like now?
I'm going to tell you a story how I ended up in the Bahamas.
Okay.
So when I opened Library Trading, my hedge fund, I was told this by the compliance guys in London, and this is what's it called? I even forget now. Is it the FTA, the whatever the regulator is in the UK? I forget what it's called now. FSA.
I don't know it either. Sorry.
I think it's the FSA, the equivalent of the CFTC or the SEC.
Okay.
Anyway, so I go there. You've got to go and apply for your license. I had all my Series 3, Series 7, Series this, Series that. I had absolutely everything. And they said, you are only the third guy ever who wants to open a hedge fund in London. I said,
You're kidding.
Yeah, no, honestly.
Oh, wow.
And I said, okay, right. Well, what paperwork do I need? What do I need to do? And so they gave me a bunch of stuff, which I gave to a lawyer, and the lawyer filled it all in, and so on and so on. Anyway, so I go there for an interview, and they ask me, "What are you going to do?" And I said, "Well, I'm going to buy this and sell that." And I said, "Well, why would you buy this and sell that?" I said, "Because at the time it looks like a good idea." I mean, what do you want me to say? I can't tell you in advance what my trades are going to be.
Right.
Well, what do you mean you can't tell us in advance what your trades are going to be? I said, well, I don't know. I mean, I don't know which way the market's going to go or whatever. And basically, they were still had that old-fashioned mentality that clients give you money and you buy, I don't know, you put it 60% in equities and you put it 40% in fixed income or whatever it is. That was what they were looking for. They were thinking that these hedge fund things, okay, they just do the same thing as normal asset managers. They just leverage it up a bit.
Right.
And so they didn't like the answers I gave them about what I was going to do. And so what they did is said, okay, we'll give you a provisional license, but we'd like this guy to be in your office so he can see what you're doing.
Come on, really?
No, honestly. I mean, honest to God. So this guy turns up and he sits there and I pick up the phone and I buy some futures and I spread them against something else and so on. Then he asked me, why have you been doing this? And I said, well, you see the basis and this and that and blah, blah, blah. And I think the market rallies. I said, well, okay, what happens if the market goes down? And I said, well, I'm going to lose money. It's as simple as that. So anyway, this guy turns up for about literally 2 weeks every day. And at the end of the 2 weeks, he says, I still don't understand a damn thing that you're doing or why you're doing it. And I said, well, you don't have to understand. It's not your job to understand. All you have to do is see, am I acting responsibly or am I irresponsible? But I guess the only people that matter and the only judgment of the people who matter is my clients. If they're happy, they're happy. If they're unhappy, they're going to take the money away. It's as simple as that. So anyway, I was getting very frustrated, and I was talking to a friend of mine, and he said, why don't you go offshore? And I said, what's this offshore thing? And I said, well, you can go somewhere in the Caribbean and open a hedge fund in 2 weeks. So I and still trade it from London. It makes no difference at all. It's just based there. That's all. And you're regulated by whoever, and that's it. If your customers don't mind, it's much easier.
Right.
So my customers didn't mind. They couldn't care less where it was registered. So I picked up the phone, looked on the map. Now, which island is really close to the USA so I can, go up and down, and landed in the Bahamas. And that's why it was based in the Bahamas, because it was close to the USA and not in the UK.
Wow. That's a great story. So you go start this hedge fund that it's going to be based in the Bahamas. And I guess you had already been going back and forth there during the time of the hedge fund. Like, you weren't living full time in the Bahamas, were you at that point?
No, I wasn't living full time. I had to spend a certain amount of time out there for regulatory reasons and tax reasons and stuff like that. But no, I wasn't living, most of the time there. I was living something like 3 months of the year there, basically an extended holiday.
And so when you retired, did you move full time to the Bahamas?
I didn't move straight away.
No.
I moved in 2004, I believe.
Okay. When you finally had it with the London weather and decided the Bahamas is a little nicer.
Yes. So yeah, I moved out there and been there ever since.
You and Sean Connery. Do you ever see him at the bars? Do you ever see him at the bars?
Yes, I've seen him several times. I don't know him. I can't claim that he's my friend. But there you go. There are a lot of interesting characters there, mostly crooks. people who've had to flee for one reason or another.
That's
But
right.
they're all very nice people. And lots of Canadians, by the way. I mean, the Bahamas has become almost a Canadian colony.
Yes,
Yeah, all the snowbirds love it down there.
That's right. We just are so desperate to get away from the winters that we will invade any place that is hot in the winter months. Okay, so let's talk about this. You're there. You're trading your own account. Now, I've come across you because I found you on Twitter, and on Twitter you're there, and you have this charity. So why don't you tell us about your charity, because I think it's fascinating, and then after that we'll get into your market calls. But before then, let's just learn about this charity.
Okay. When was this? I guess sometime in 2013 or 2014. I forget now, but it's irrelevant, really. A friend of mine and I saw how badly animals were being treated in the Bahamas, especially horses that are used to take the tourists around Nassau in buggies, and there are really no standards of how, sort of animal welfare and animal protection. And we saw a sight one day, which was literally this poor little horse dragging around some fat tourists, and it just collapsed. They came and they shot him on the spot, and that was that. It was really quite shocking. And you know us Brits, we can stand any amount of human cruelty, but no amount of animal cruelty. So what we decided to do was buy a piece of land and build some stables and look after these poor horses that, after they'd gone through their working life cycle, because they'd just be killed otherwise. So we ended up with a few horses, and word spread, and then we got given some donkeys, and then goats, and then sheep, and the whole thing just escalated, kind of thing.
You have your own little petting zoo at this point.
Yeah, no,
it's an old age petting zoo.
Yes, and actually, a lot of these animals weren't very old. They were just very thin, emaciated, very, had a very, very tough life, very hard life. So anyway, we did this, and it ended up starting costing a huge amount of money per year, with all the vet's fees and the feed and the staff to look after these animals, because animals need looking after. You can't just sort of leave them in a paddock and that's that. They need all sorts of. I mean, anyone who's had horses, they'll know how much it costs to keep a horse.
Right.
And we had a lot. So we just thought, well, what can we do to attract, to fund this hobby of ours, as it were? And since we had some market knowledge, we thought, well, why don't we try and advise people, not on a formal basis, but give people ideas and tell them how we think and why we think it, and basically try to help people online, because I'd noticed that a lot of information online is very, very bad indeed. So that's why we did it, and we've been doing it. I've been doing it ever since. A friend of mine moved away a couple of years ago, and I like it because I've formed a little bit of a community, and I like the people who I interact with every day, who follow me, and I want them to be successful, and I want them to understand how I think and why I think it's important that they not make the mistakes that other people are bound to make with all the rubbish theories that are out there on Twitter, available to anyone to copy for free.
Right. So why don't you tell people where they can find that? Just give a plug, since we're always.
Well, charityhedgefund.com.
There we go. So if those who want to do it, and we'll remind you at the end. But that's a great story. So let's talk a little bit about what you're actually, what you talk about on your charityhedgefund.com, the markets. And do you focus mostly on the bond market, or is it a macro thing where you do?
No, it's a macro thing. Basically, I have ended up trading almost exclusively the indices and bonds and all the futures, so volatility futures, the whole curve in the bonds, bonds, bubble,
Right.
all the indices, the equity indices throughout the world. That's it, basically. The normal macro stuff.
Right. Okay. So let's talk about what you're seeing out there. You mentioned that there's a lot of bad theories out there. Let's jump into them. Give me an example of a bad theory that's out there that's getting propagated through FinTwit that's going to cost people dough.
I mean, there are the normal perma bear, sort of
Right.
stories. I'm neither a perma bull nor a perma bear. I think that the market, the equity indices, their natural progression is upwards.
Right.
It's just a question of timing it and not being in a trade, not being long at the absolute worst possible time, or how to mitigate that risk. And that is one of those things that I do mostly on Charity Hedge Fund. I structure trades slightly better than be long or be short.
Okay. And you're doing that mostly through options?
Yes.
Okay.
But it's very important to be able to pick the right level of where the risk is. For example, at the moment, I don't think I'll be saying anything too outrageous to say that the real risk is at 34.18 to 20. That is the risk area. Below there, very, very bad things can happen in the S&Ps, while above it, it looks okay, Right. So I would structure a trade that has that level in mind. So that you can let your longs run, unless it starts trading underneath that level.
Now,
and I think that's something that people don't do. They don't look at where the real danger points, the pivot points of the market are, and structure their trades around them.
Do you think that even considering that those pivot points are often filled with higher vol, because of the skew, it's still worth it to, the market's still underpriced that, or it's still worth it?
No, I haven't found that the market prices those my pivot points correctly. In fact, I've made most of my money by doing exactly that, having the right strike in the combination of my trade.
Is that right strike a function of technical analysis or watching the markets?
Yes, absolutely.
Okay.
But technical analysis is nothing else but watching the market. It's just an easier way to pictorially represent what you have been watching. I find technical analysis indispensable, not because it tells me where something is going to go to. I have absolutely no idea what the high is going to be in the next 3 months in anything. But what it does say is to give the market a chance if it does this or that. So do you understand what I'm saying?
Yeah.
Unless the market is breaking certain levels, if it's holding those levels, give it a chance.
Right.
The odds are in your favor if you trade that way. That's what I've found.
And so, how complicated are the option positions that you'll often put on?
They can be very simple, or they can be quite complicated. One of the most complicated ones I've had in the past, 6 months or something. This year has gone very quickly, hasn't it?
Yeah.
Has been basically long of the Russell and the Nasdaq, and short of S&Ps at certain levels, and that trade has there's an outperformance of something like 15%. So that's
And
been
you put that on as a spread using options?
yeah.
Yeah, okay, and based upon different levels. What I've noticed that the Nasdaq and the Russell are almost being trading inversely correlated at times. Have you noticed that or like as you're watching on a kind of daily basis?
In the past couple of weeks, yes.
Yeah, it's
But
kind of shocking.
but that's because it's moved so much. I mean, if you look at the spread, and that's mainly what I do. I look at the spreads and see what is moving and what is leading and what is lagging. If you have a look at a chart of the Nasdaq against that Russell, it's moved so much that
Right.
really needs a rest.
Right. And then, will you also take that same strategy and apply them to sectors? Like, would you be doing the same with the banks, or is it generally you're trading the big, larger, more liquid indexes?
No, well, I'll do the various XLFs, XLKs, XLYs. I'll do the ETF sectors as well. Yeah, but that's not a huge part of what I do. I prefer to have more concentrated positions in bonds or the indices.
Right. So let's talk a little bit about bonds in the current environment, because they've gone quite sleepy, and the move hit an all-time low.
I've had a very good couple of weeks, even month in bonds. The curve has been steepening. The 530s has gone from 105 to 120.
Right.
Okay, that's only 15 basis points, but it's 10% of what it's worth. It's a big move.
Right.
If you get the curve right, that actually tells you a lot. And and also the fact that long bonds have moved so little relatively to where they could go, i.e. they're holding in a range now, 105 to 140 on the curve against fives. And that tells me that the Fed is managing this process extremely well.
Right.
They don't yet need to do an operation twist.
Okay.
And that gives me the confidence to buy the extreme dip in Nasdaq. Nasdaq basically doesn't like higher rates. It's very susceptible to higher bond yields.
Right.
But if you know that you are going to have a very, very good bid around the 140 level in 530s, and the Fed's there, and when the market, when the Nasdaq gets to a low, which coincides with that 140 level, you have the confidence to buy it. And spread it against something else, or buy it outright, or just create a bullish option strategy. So the curve, I think, basically dictates what these indices do. And also, in the past couple of days, had a really great time trading the European bonds, which have broken out on the downside, which nobody was expecting. But the spreads were telling you all the time, watch out, Europe is going to go. Europe is going to go. And it did. So no, bonds are not boring. You can make a lot of money in bonds.
So listen, that's a fascinating thought process, and let's just jump into that a little bit, because I think some people will have been lost in terms of your thinking. Let's start with the idea that the Nasdaq is very sensitive to yields, and especially long yields. I have my theory as to why that is. Why don't you give me yours?
Well, you are looking at the Nasdaq is very heavy on companies that have that basically growth, right?
Right.
So it makes a hell of a difference to the price of the equity whether you are discounted by 130 against, if the long bond is at 130 or is at 230.
Right.
In terms of yield. So, and of course, since equities are basically perpetual bonds, it's the long end which matters to the Nasdaq. More so than to the S&Ps, and more so especially than to the Dow. They're all susceptible to it. They're all very sensitive to it, but the Nasdaq especially.
Right. I completely agree. The Nasdaq, those high flying growth stocks have the longest duration because
Correct.
the earnings are all out in front of you, and think about it. So I completely agree.
You're looking for the growth of the earnings in the future,
right?
Not now, in the future. Yeah. So if you assume that those growth projections are right, of course they're not going to be, but if you assume they're right, right. You are discounting by a completely different number those, and the really big earnings are going to be in 10 years, 20 years, right? I mean, that's where you're looking out towards.
Right. So
and that's why.
Yeah. So I didn't mean to interrupt. So let's go to your thinking now. So you're watching the bond market, and the bond market is backing up. Yields are headed higher. The curve is steepening, but you hit a point where you say, this is it. This is the bond market is going to be bid here. Is that correct?
You get to a point where the Fed has to do something, because if the whole point of what they are doing is to get bond yields lower, and therefore help the market digest this COVID thing and basically sort of kick the can down the road and discount the earnings by a lower number, right? A lower denominator. Yeah. If they don't do that, if they allow the curve to steepen beyond a certain level, the curve just starts cascading.
Right.
I've seen it. I've seen it in '87, and nothing good came from it.
Okay.
You saw it again in 2000 and 2001. And absolutely nothing good came from it. That is the only thing that kills the stock market is the bond market.
Okay. So your argument at this point is that the Fed has to step in here as the curve steepens. This hits the point where the Fed's going to step in, support the bond market, and at that point, go ahead.
You have technical analysis, and anybody can have a look at a chart of 5s, 30s.
Right.
For example, I always use 5s rather than 2s because now 2s are impossible to use because they're just not going to move. They're not going to move in a basis point.
Right.
So you use 5s, 30s to have a look at what the curve is doing. Anybody can have a look, and they'll see that there's a very, very natural area of support at 140. The curve started steepening back in 2018, but it was a bear steepening in yields.
Right.
Now it's beginning to be a bull steepening in yields.
Okay.
And that is what has been holding NASDAQ back over the last couple of weeks.
Right.
While the curve is bull steepening, there is absolutely no chance that the NASDAQ can be a leader, i.e. that tech can be a leader. And if tech is 35% of the S&P or whatever the hell it is, if 35% is dragging, the other 65% better be on fire.
Right.
And in this economy, they're not going to be on fire.
Right.
So that is why the market is basically now range trading, up and down, waiting for some kind of input from the bonds.
Right.
Because you will actually find, and this is going to be the bit that people don't understand. The worse the economy, the better NASDAQ will do.
That's right, because the long end will go bid on in terms of yield will go down, and
Correct.
it'll outperform.
Correct. And it'll outperform. And
Yeah.
Since, sort of tech is 35%, it'll start going up, start going up when everybody wants to short it.
Right. So you're looking at the bond market, you're watching the yield curve, and you hit this point where you say, I think that the bond market is going to stop going down, meaning the yields are going to stop rising. And therefore, I'm going to express that by going out and buying the NASDAQ. Is that correct? And you're going to
yes, or really spread it against something, or do a bullish or do an outright bullish options trade, something that allows me to sleep at night, because there are no guarantees in life.
Right.
The odds of the curve steepening from that point might be very, very low, but on the other hand, it can happen. The Fed can lose control. It's unlikely, but it can definitely happen, and then things get really ugly.
So is this back to when you talked about being on the desk at Salomon Brothers and seeing how all the different pieces move together? Is that really kind of what you consider your edge, being able to understand how all these different pieces move together and therefore construct a strategy that takes advantage of that?
I recognize that I've had the enormous good luck to actually learn by losing other people's money. You laugh, but I think it's very important. And I lost other people's money in great quantities over a very long period of time. I didn't, but it's very important to understand how all the pieces fit together, and what the likelihood of things happening is. Trading is no different from making the odds at a racetrack.
Right.
I don't think so. And options actually allow you to improve those odds in your favor. So I think anybody who doesn't trade options because they think they're too risky is actually probably handicapping themselves. I think everyone should read a few books on options and thoroughly understand how they work. And basically, the thing that enables you to have very decent profits is patience. And it's much easier to be patient when you have a soft stop,
right,
like an option, and that gives you the confidence to allow the trade to run and run and run.
Nice. Okay, so
at least in my case, I mean, I know everyone's different, but my psychology, I couldn't sleep at night if I was, completely naked in my positions. I'd want to be tick watching, and that is also extremely bad.
Right. Let's talk about other mistakes that you see people doing on Twitter. So one of them, is by not getting to be a perma of anything, and I completely agree with you there. What are the other things you see that are going wrong on Twitter, or not just in Twitter, in general? What mistakes are investors making that you've had many years of trading that you could share with them?
Well, the one of the main mistakes, I don't know if I can call it a mistake, but people don't look at what the spreads are telling them at that point in time. I look at, in fact, I computerized the whole thing. I look at thousands of components, and I put it all together in a score.
Okay.
And so basically from 0 to minus 100, or 0 to plus 100. And when you have a very strong positive score, i.e. thousands of spreads are telling you one thing, and that is that that equities are likely to outperform the fixed income. It's on a relative basis, not on an absolute basis, but on a relative basis.
Okay.
It is almost suicide when the market is down 10, 12% to go short. Okay.
Right.
So, and that is precisely what happened, a couple of weeks ago when we were trading at 3,200 in the S&Ps, and people were really bearish, and I kept on saying, no, the spreads are telling you exactly the opposite.
Could you give me some examples of what those spreads look like? Like, I assume you're talking about more than just credit spreads and things like that. These are proprietary spreads.
We're talking about a lot of spreads. We're talking about naturally credit spreads. We're talking about the individual sectors of the indices.
Right.
You know, let's pick one which everybody will know: XLY over XLP.
Right. Okay.
All the then we have all the bonds, the yield curve, what the yield curve is doing, which way it's steepening or flattening. Then we have volatility, which is a very, very important component. If volatility is trending down, and you are down, I don't know, double digits, expecting a further fall of double digits is ridiculous.
Right.
So you have, when you combine a total score of all these spreads, and literally, I've got thousands of them in there, all ranked according to what I think is the most important down to the least important, and given a score for each. When it's extremely bullish, it's ridiculous to expect a complete cataclysm in the market. Basically, what it's saying is buy the dip, or don't buy such a shallow dip, but buy a decent dip. And that's why I really don't think that this presidential election is going to matter in the slightest, because the spreads are still positive and they're saying the resolution is to the upside. That's what they're saying at the moment. Things could change in a week or 2 weeks or 3 weeks. But at the moment, you have to give the market the benefit of the doubt.
I think, if I'm not mistaken, that Stanley Druckenmiller is a big fan of using those kind of intermarket equity spreads.
That's the way he trades. But that's not surprising because, I guess he learned the same way as I did.
Right. Now, he talks about that as not working as well as it used to. Have you found that the equities in per se have not been working as well?
It's been very whippy.
Okay.
But I wouldn't say that it's not working. It's giving you very good signals. Really, this year has been a very hard year because of, a once in 100-year occurrence, right? This is a pandemic. It's not something that that the market has seen for a very long time. And therefore, it's been very whippy, and spreads take a long time to turn, a very long time to turn.
Right.
But if you're an experienced trader, and if you've been doing something for 30 odd years, you know that. Okay, so you have your automatic stops, you have your soft stops, you have your option positions, and you live with it. Okay, you manage the volatility. That's your job. So all that matters is how you recover from the drawdown. Right. Everyone's going to have a drawdown. That's the most natural thing in the world, including Stanley Druckenmiller and including Paul Tudor Jones or whoever. Everyone has drawdowns.
Right.
But the management of the drawdowns and how you come back, how quickly you come back, those are the signs of a really, really good trader.
Okay. Well, you touched upon it there. You mentioned some of the greats, and that how you come back from the drawdowns is what really distinguishes them. Is there anything else that you think really kind of sets them apart?
Well, to tell you the truth, the only guy I've met personally is Louis Bacon. And I can't say that that's because he lived in the Bahamas.
Okay.
But I can't say that I spotted anything in his personality that I thought, that's it. That's why he's a great trader.
Well,
he's
what about
nice
the people around you? You were sat on a desk. You've thought a lot of things. You've thought a lot about what makes someone good and what holds them back. And you talk to people with your charity hedge fund. what have you found that kind of are the characteristics of somebody who is more likely to succeed?
I think the essential quality is A, patience, but B, being able to pull the trigger when you know, i.e. knowing how to determine when you are wrong, and being able to just close the position and walk away and not try to make it up straight away. Those are qualities, I think, which are the absolute basics. I don't think you can be a good trader if you don't have those. Now, after that, there are a whole load of things. I've seen some people who are fantastic at mathematics, and they construct trades that I couldn't begin to construct, and see things that I don't see at all, and make those tiny little, bid offer differences. That's not me. I have no idea where the next 10 ticks or 20 ticks in S&Ps are going to be, and I'm not interested. What I'm interested in is trading at really, really good levels when everything is telling me that the odds are overwhelmingly in the favor of one direction from now. And then one can structure a really cheap trade to take advantage of that opportunity.
Well, if you could,
I haven't really traded in 3 weeks. I haven't really traded the S&Ps since 3,200.
Right.
that's it. And I've still got quite a bit of them. I've been taking profits, going in and out, but I've still got quite a bit of them because I think it's still the way to be is to be long and give the market a chance.
Right. And structuring a trade so that you're able to sit through that and sleep through that is obviously a very big component of how you trade.
Absolutely.
Right. So, Nick, what would you give young people today that are interested in the market? What advice would you give them?
Well, I would definitely advise them to go the route that I did, i.e. to have a few years, and I mean years, not months. I'm talking about 4, 5, 6 years of very good grounding in all the in every single aspect and every single market, from FX to fixed income to swaps. Everything you need to understand where the potential really difficult pitfalls are,
right?
So you don't fall into them with your own money. The one thing that it teaches you is to take losses quickly, and to let the profits run, because you can see the logic and you can see the price action confirming your logic. So that's the only advice I would give somebody. I think I couldn't just sit in a darkened room and trade for a couple of ticks up or down. I don't know how those people do it. Take my hat off to them if they're successful. But I must have an idea. I must have a view, a macro view of what is going on, to be able to identify levels and take advantage of them.
Right. I'm a big believer that everyone needs to find the strategy that works for them. And it sounds like you found the perfect kind of strategy of melding these, kind of being a macro thinker that watches everything and then combining it with options to make it so that you're patient. And you've found the secret sauce for yourself. And I think it's been great sharing that with everyone else, that's given them something to think about. For those that want to learn more and follow you, why don't you repeat one last time the name of your website and also your Twitter handle so that people can make sure that they reach out and say hi and follow you on Twitter?
Okay, the Twitter handle is at Nick Giva, and the website is www.charityhedgefund.com.
Well, it's been a real pleasure having you on. Someday when I'm the next time I'm in the Bahamas, when they let us out of Canada again,
Look me up.
Yes,
no, we're under lockdown at the moment, so it's
well, so
you
are
can't
we.
come yet.
We're not allowed out either. We're not even allowed to travel within some provinces, so it's even worse here. But someday when this is all through, I look forward to coming by, and maybe we can go knock on Sean Connery's house and say hello.
Absolutely. I'm not sure that Sean would appreciate us knocking on his door, but I'll take you to the bar where he comes to regularly.
Okay, well, great. Well, thank you very much, Nick. Take care. Okay, it's our pleasure to welcome back to the show Morris Sachs. Morris, thanks for joining us.
Oh, Kevin, it's always a pleasure to chat with you.
Yeah, no, it's going to be a lot of fun. I've been looking forward to this for a long time. I think neither one of us are really talking charts kind of guys, right? Like I was joking and saying there is going to be no talking charts. It's like the soup Nazi.
Well, there's that comment about every ship at the bottom of the ocean has a chart on it. although I have to tell you, a couple of guys I think the world of use it in their kind of kung fu. So I have a little respect for it, but I'm not your go-to guy on the charts, no.
Okay, but you are my go-to guy when it comes to talking about the hedge fund industry throughout the years. So, you know what you've spent? Is it 4 decades? Am I aging you a little too much? That on Wall Street in Greenwich?
Well, let's see. I started working full-time in Chicago in 1983, and then I moved to New York, and then I moved to Greenwich in 1987.
Right.
And this is 2020.
Yeah. So there we go. That's almost 40 years.
Yeah.
I'm rounding up.
That's okay. So well, I was just going to say the good news is with the pandemic, my house is almost back to where I bought it. Price.
What do you mean in terms of the house pricing going down?
Well, all these hedge fund guys came in and, they pushed the prices up of the houses in the late 90s and early aughts, right?
Right.
And then people realized this is a great address, but this is not that great a place to live. And so all the New Yorkers are running out of New York, and they're like, "Oh, I see. They're
all headed. I get it. Yeah. So you're finally on side. Okay, so now let's talk about the hedge fund industry and the changes you've seen throughout the years. I guess I just want to be clear. Most of your time was actually spent on a prop desk at a bank, right?
Yeah.
On the sell side, but
right.
But almost these hedge fund industry guys would have been your competition, right? Like
absolutely.
Right? You were one of the bad guys that when long-term capital was in trouble, they would get the sell side guys to come in and look at their books to see if they could help, and you would just front run all their positions.
Front run's a funny term.
Okay. But you would appropriately hedge your own book to make sure you protect yourselves.
I think we talked about this a little last time, where we had very similar trades on to long term, but we had some hedges in the euro dollar contracts that we made money on as the rates dropped. As people,
but it's So what has been your biggest kind of surprise over the last 40 years in terms of how this industry has changed? Like with the hedge fund industry? When you started, it was those old school macro kind of swashbuckler kind of guys that were going for it. You were around with the Tudor Jones and the Steinhardts of the world. Like that's when you started. Yeah. And by the end of it, it was these kind of asset gathering, fee hogging kind of more boring and stable, institutions. A lot of the good stories must have mostly been from the 80s and 90s as opposed to the 2000s and 2010s.
Well, there were a lot fewer hedge funds, right? And I really became aware of them, sort of in the late 80s, early 90s. There was one fellow I worked with at Greenwich Capital, Richard Axelrod, who terrific guy, and he left Greenwich and went to Moore Capital.
Okay, right.
And he's been there, I think, ever since and done a great job as a macro trader. Mm-hmm. But what I think sort of happened was, as people saw the comp structure of these hedge funds, more people moved into the space, right?
Right.
And so as people did well, whether it was, Paul Jones or George Soros with Stanley Druckenmiller, Michael Steinhardt, it's just like that saying about where do you look for gold? Next to a gold mine.
Right. Okay.
So
That's
people decided to get into the business. So there were different types of these hedge funds, and the early guys, had an advantage in that, the markets were less efficient, and they had an angle. So like one of the first relative value shops that did very well, they're still around. It's a firm called Adams, Viner and Mosler.
Okay.
And they run a fund called Triple I, which I think is Illinois.
Warren Mosler, that's the father of MMT, right?
Yeah. Now, these are smart guys, right?
Yeah.
And they've done very well. And so it's a little bit of one of these things is you watch what the clients do and you reverse engineer it. And then you start copying the trades. And then if you're working at Bank XYZ and you don't like your bonus and you're a little bit of an entrepreneur, you go out and
you start your own firm.
Yeah.
Or you work for for Louis Bacon or somebody like that.
So what I think over time, you've had the proliferation of funds, and it's sort of surprising to me because you have institutions that are chasing returns, and what surprises me is that after all these years, people are still giving money to hedge funds.
It's surprising to you because the returns, especially after this compensation that they're taking, are so low.
Absolutely. There was a paper, and while we're talking, maybe I'll be able to find it. But it was something that I had kind of talked to you about a while ago, where if you decide you're not going to have one hedge fund manager, because if you have one guy and it's a Madoff, you're out of business, right?
Right.
So you have to spread your risk across.
Yeah.
So one of these guys, an academic, did a paper. I think I've got it here. It's by the Ohio State University, the performance of hedge fund performance fees. It just came out, and it basically is what we're talking about here, which is, this is especially great for the hedge fund managers,
right?
But it's not that great for the investors. And
so, what is driving that? Why do you think they still get business?
It's a really good question. I think it's a little bit because the industry pushes people in that direction. So if you're a high wealth, a high net worth broker, or excuse me, I want to be specific, a high net worth advisor, not a broker.
Okay. They don't like being called broker these days.
Well, I differentiate between advisors and brokers. We can talk about that after I've had my beer. But they get a drag on it. So,
no, listen, they do a lot better putting them in that than some, ETF that does the S&P 500, right?
Well, the advisors do.
Right, exactly.
So if you put the guy's $50 million in the SPY, there's an 8 basis point charge on that, right?
Right, yeah.
Or if you talk the guy into buying an Admiral fund or something, I think there's a 50 basis point overrider.
But surely there's some guys that are worth paying up for. There's got to be hedge funds that are it can't all be smoke and mirrors. Like there's got to be some guys like who over the years have you respected and would you have given your money to?
That's a tough one because I there's a lot of talented guys out there. Okay. I think that I've just spent the last 5 or 6 years of my life unwinding all of this stuff I've had with these guys over the years, because when you get right down to it, I would tell you that out of all the hedge funds I've invested with and all the ones that I've known,
Yeah.
there's only one fund, and I don't know that I really should mention their name, but
Okay, but just tell the type of fund, or
it's I'll tell you exactly. It's a real estate fund that goes in and they hunt for, properties that are distressed,
right,
and they buy them and they reposition, they redesign.
Do you think that because it's in the real estate market that there's more alpha to be had there?
Yes.
It's almost like the hedge funds in the 1980s. It was,
Yeah, there's more alpha, I guess is the best way to put it.
And so do you think that the markets, the lack of alpha, like you talked about how it was so great in the 80s for these hedge funds, do you think that that's just a function of more people being attracted to it and you're getting smarter people? Like in the past, you used to compete with people that didn't have degrees. Now, all of a sudden, you're competing against people that have financial engineering
100%. 100%. So, you wrote a piece the other day, your blog, the macrotourist.com.
Oh, yeah, that's very kind of
I'm sorry, I get the plug-in for you. We're running a special, folks.
There's no specials, just for and everyone pays the same. I don't have a lot of kind of rules, but that is one of the things I believe. I'm like the Apple of macro newsletter writers. And in fact, the people I go through, they tell me I should do this and do these promotions. And I say, nope, I'm not doing it. Everyone pays the same, because there's nothing that makes me madder is that when you sign up for something and then you find out some other guy has got it for half price because there's some sort of special and stuff like that. So it drives me insane. So I do not do that. I pick a fair price and everyone pays that. Anyways.
Well, okay. But I digress. In your blog post, you were talking about the Eurodollar futures, right? And when I started being aware of Eurodollar futures, they had 8 contracts the first 2 years, which would be the whites and then the reds, right? And then
okay.
So they
only let's just for people to understand this, they're quarterly expiries,
right?
And so they're March, June, September, or December, and they would list 2 years out when you first started,
right. And so every so many years, they would say, we're going to add another year, we're going to add another year. And the next thing you know, I'm at Greenwich Capital, and they announced they're going to have like 5 more years out the back.
Right, okay.
Okay. And this is the point about the alpha. So at that point, one of my partners was had been a physics professor, so he was really good with the math. Okay. And he said, and I won't attempt to do the accent, but he said, I think they're going to misprice these back contracts because of the convexity.
Right. Okay.
And so what we realized was everybody who was trading the contracts thought they were $25 a basis point because that was the contract value. But because of the present value of an 01, the DV1s were different.
Yeah, okay. Right. Okay. Yeah, okay.
So they start trading. They're trading the wrong price, and we fill everybody with them. And then 4 or 5 months later, all of a sudden, push comes to shove, and they trade the value, right? So
interesting.
I mean, it's obviously trying to sound like I'm a smart guy, figure something out, but the object or the point here is that, years and years and years ago, people didn't know these things. So it was easy to create your alpha.
Right. Okay.
Now it's in textbooks. So that's part of it. I think there's half as many listed stocks as there were 20 years ago. So, there's more guys, there's more money, there's the same amount of leverage, there's less things to look at. No.
Okay. Here, I'll give you a little pushback to that, though. It seems to me that when you look back at it, it's always obvious and always better in the past. Meaning that, like, you always look back and go, oh, it was so easy back then. And I can't tell you the number of people. One of the trades that I came up with was I was sitting on an institutional equity desk, and I realized that stocks in Canada and the U.S. were interlisted. And they had just teams of guys that were arbing them, buying in New York, selling in Toronto. And I came up with this idea that we should automate it. And when I started writing the program, my boss said, what are you doing? And I said, I'm writing this program to do that. He says, why are you doing that? I already have 13 guys doing it, right? And the point is that I said, well, this is eventually what's going to happen, and the computer's going to win. And at the time, it was really difficult to do that automated trading. It seems so simple now. It seems like, oh, geez, like that's just a walk in the park. Anyone can do it. But at the time, we needed to have these Sun workstations. We needed to write these things. There was a million things that made that a difficult trade. One of the pushbacks that I always give to people is that it always seems obvious and easy when you look back at history. And I look at today and I think to myself, like, I'll be honest, I missed the high frequency trading ARB. And like, as a guy that was doing interlisted ARB and automating those things, that should have naturally been something I would have done. But I didn't do it. I was, doing okay with this other ARB, doing some other things, and I got lazy. And it kind of went off without me. And so one of the things that I look at it and say, people say it's so hard today, but look at Jim Simmons, anyways, at Renaissance. He's making a fortune, and it's always hard. And it's just different people making the money, and they never tell you about it. And it's just kind of those that are clinging to the old past, like me, that was sitting around trying to do interlisted ARB, whereas all the other guys were doing high frequency trading, and I kind of wonder if this is just kind of like the circle of life. It's like the Disney movie or whatever it is, the Lion King. That we always just end up like the Bruce Springsteen song, sitting around talking about the glory days. But the reality is that there's always glory days being created with someone else, and we don't know about them today.
Yeah, I'm not really sure how to respond to that. I mean, we're talking about how we used to make money based on market inefficiencies.
Right. But do you think there's some other market inefficiency that's happening that we just don't know about? Or do you think that there's just nobody making money?
No, well, for instance, there's this, I'm going to delve into something that I'm clearly unqualified to talk about, but why not?
Yeah, sure. It's the market huddle. We do it all the time.
There's these products called SPACs, special purpose.
Yeah, right. Exactly. Okay, yeah.
Okay. So these things have been around for like 10 years.
Oh, actually, I think they're longer than that, but they've gotten
fine.
popular over the last 10 years. Yeah. Okay.
Well, so they've been around for a long time, yet in the last 18 months, they've gone psycho, right?
Right.
And so a friend of mine is working on one right now, and he kind of went through the math with me, and if it goes, it's redonk. Like you make all this money, okay?
Right.
And
he's working on it as a sponsor. You're saying?
Yes.
Okay.
He's a very bright guy. He's a very talented guy, and I hope they make a ton of money. But I sat down and I just can't quite see where the money comes from, right? These sponsors make a lot of money if the deal goes
right.
Okay. And if the deal goes great, they make an insane amount of money.
Yeah.
Well, that money's got to come from somewhere. And
no, I think that if the deal doesn't go, like for example, if they don't convince the shareholders of the SPAC to actually vote for a deal, then I think that they're out their money. And I think that the reality is that they've been in an up market, so all of them have been going through. But theoretically, they're on the hook. So like if a SPAC goes and does like a $300 million SPAC, and then the sponsors spend 10, sponsoring it, they lose that 10 million if they don't convince the shareholders to go ahead and actually buy the deal. So he theoretically, your buddy, could theoretically be out the money that he has spent up front.
Okay. Yeah. All right. You learn something
listen,
new on the market huddle, right?
Yeah. But I think the SPACs are a great example of something that one of my, like an old competitor that actually used to do my job for another bank. He went on and he started their own hedge fund with a buddy, and the two of them do it. And they came upon this strategy and they realized it was a great strategy. And they went and they started like raising serious money. They started with their institutional type money and they eventually expanded it to retail, and it's been a terrific strategy. And I think it's one of these things that you have to always be open to new ideas, because there's always someone somewhere making money. And one of the things that I worry about is that when we sit around and we talk about, oh, it was so great, when we used to do this XYZ ARB, the reality is that there's some new XYZ ARB that's happening that we're missing. And that's what I worry about. Anyways, there's no need to comment. And I just kind of throwing it out there for an idea.
I would just like to throw something out here, which is, first is, I agree that you have to keep looking for new things.
Right.
Okay. There's no doubt, because stuff doesn't sit there forever.
Right.
But the one thing I want to point out is there's a book. It's written in Portuguese, but I can get a translation for you.
Yeah.
It's called Confusion of Confusions. It was written in 1688.
Yeah.
Okay. So it's several hundred years ago, right?
Yeah.
In that book, they discuss put-call parity.
Come on.
They discuss
Really?
Term repo. They discuss rehypothecation. They talk about fail to deliver.
Do you know what? They're aliens from the future.
But they don't call it put-call parity.
Right.
But they talk about how you can buy these things called opsies, which act like an anchor for a ship at sea during a storm, and you're limited to your premium. And they go through this thing, and I've actually several times tried to sit down and write a modern, updated version of the thing, because there's so many of these little Easter eggs in there. Why do I bring this up? I bring it up because if they knew put-call parity 400 years ago, you're going to tell me somebody just figured something else out?
That's right.
Maybe.
There's nothing new under the sun. And at the end of the day, isn't that what it all comes down to? Is it's human beings and we make the same mistakes over and over again?
That's
like, isn't that really what we're arbing, is the fact that the human beings kind of do the same behavior? We're prone to the same herding and the same kind of wanting to be part of the crowd and all those things. Isn't that really truly the real alpha?
Being able to pick up on that?
For sure. Like that.
Well, that's why, like a Paul Tudor Jones, for instance, I think it was in my kind of limited interaction with him, just has a great sense of, the trend, right?
Right.
Now, I mean, he doesn't know me from Adam, other than that limited experience I had with him a zillion years ago. And he has these great rules, which he talks about, but I think his gift is he's got a sense for the trend. And that's the being able to pick up the herd instinct that you were talking about.
And do you think that that's a gift of, like, when you go through the greats, is that what makes them great? Or do you think that they all have, obviously they probably all are different, but are they dramatically different? Like, if you go through and think back to your other, great traders that you've experienced, and they don't even need to be famous, just people that you've looked at and said, this guy, wow, this person, guy or gal can take risk and is just outstanding and has got a gift for this. Is it always the same, or what are the nuances that you notice?
Well, the thing I've seen over the years with all types of markets and the traders within those different markets, so whether it was a bean trader or a mortgage-backed trader or an option trader, whatever, is they have a clear view of what they're doing and have an unbelievable command of risk management.
Okay.
And, because with any of these things, people know what the trades are, right? Other than
Right.
if you come up with a new strategy, people know, if you want to think the market's going up, you buy the high vol stocks, that kind of thing.
Yeah.
It's how do you manage the position once you have it on,
Okay.
right? And so, they have these quaint little things you read about in Reminiscences of a Stock Operator. I made most of my money sitting.
Right. Yeah.
I mean, it's all about the position management and understanding how to take something and extract a profit from it. And so, you put a trade on, and let's say you think it's 80-20 in your favor. Okay. And the thing moves. And let's say there's absolutely no new information.
Right.
And you've got a nice big profit in it. Well, it's not 80-20 anymore, is it? Now
No,
maybe it's
absolutely,
50-50.
Right.
So now at 50-50, what's your edge? Well, maybe you feel like you can roll your strikes up, or maybe you feed out a little bit, you raise your or lower your average cost, or
Right.
maybe you pick up new information. You decide it's a better trade now than when you put it on.
Okay.
That kind of thing.
So the managing of the position is where the true alpha is created, you're arguing. Like that we almost, like a lot of us, it doesn't take much to come up with a good idea. It takes a lot to, it's not hard to be right, it's hard to make money.
Yes, and it's funny how you phrase that, because one of these little sayings I always hit my traders with was, this is not about being right. This is about making money. And, you don't want to lose sight of that fact, right? And that's one of the interesting things, which is when you go into these hedge fund, like when we were trying to raise money for the second fund I looked at, we're new, so we would meet with these fund of fund guys, which, I mean, they're they're up there with real estate brokers in my world, which is south. But they're where was I going with this other than slamming people?
Yeah, you got confused when you got the chance to slam the brokers again.
Oh, the fund of fund guys, right? Yeah. They're looking for a story.
That's right. Because they just want to make a sale. They don't really care about it. They're not really trying to pick the right one. Yeah,
and so I remember the second fund I worked at was relative value ARB. We had done it for 30 years, and we had never lost money. Okay. And so my partner, who was sort of the point guy for the presentation, we'd go through these whole basis trades, how we would do the trade, and we'd hedge all the pieces out. And you could all of a sudden start to see these guys' eyes glaze over. And, finally, as we're finding these pitches, I'm like, hey, Joe Smith, I said, let's just fucking dumb this down. Because they're just...
Yeah, they don't want to know the details. They want to be able to tell a story, right?
They want to tell a story, and they want to collect their fee.
Exactly.
It's all about the fees.
Okay, so let's talk about, we've kind of gone over the hedge fund industry throughout the years, but one of the things that I think is kind of really interesting for people to understand is you sat there in the trenches trading, you talk about Eurodollars when there was only, 2 years that there was listed, and you've watched them trade just a gajillion amount of different instruments, and I'm kind of fascinated when I see all these big funds with their different types of strategies, meaning that there's this fund is always long volatility and this fund is always short volatility, or not always short, but seems to always want to sell volatility. And we were laughing earlier, and I was telling you that I saw when I read Bill Gross, I would read him, and he seemed to never find an option bid that he wasn't ready to hit. Yeah. That guy was such a PIMCO, and he was for a while the king of bonds and and what did they call them? The beach. That's what the account was called. Like I think when you were working on the, you would say the beach is selling. Anyways, this is PIMCO because they were out in Newport Beach, and they were known as the beach. But it seemed to be. I would love to get your kind of feel and kind of give us a taste of what it was like when these people were doing these sorts of trades and what was driving them. What did it look like? Just give us some color.
Well, first of all, nothing I want to say is going to take anything away from Bill Gross, right? I mean, the guy just killed it. I think he's got to work on his anger management skills with his wife.
Exactly. The fart spray in the vents is definitely one. Did you hear that story?
Oh yeah, well, that's why I brought
the fart
it up.
sprays and although I actually love the story about the Picasso, wherever it was, the Picasso
they had a fake put in or something like that.
Yeah, no. So they had this Picasso. He was going through this bitter divorce with his wife, and they had this Picasso, and they decided to figure out who would be able to keep it. They would flip for it, and so they flipped for it, and she won. And he said, "Oh, don't worry. I'll bring it by tomorrow." And she says, "Don't bother. That's a fake." And she had put in a fake in his room and taken the real one.
Well, that's like that episode from Entourage with Ari.
That's a great show. That was a terrific show.
I'm just curious, a little off topic. I know we're kind of talking a lot of gossip here. Are we trying to get our ratings up? I mean, I know that my ratings were a little lower. I noticed that Lynn Alden had 8,000 views.
Oh, you know what, Lynn is an all-star. You have to just nobody can beat her. I'm the same way. I pay full price, full fare for her. She's well worth it. I laughed with her and told her that she ended up beating the floor trader that got high while he was trading in the pits, who before that was our all-time most popular download.
Yeah.
And
she's good.
She's
really
outstanding.
Good.
Yeah.
Okay,
but you are going off topic.
Okay, sorry.
Morris, I'm dragging you back. Give us first of all, do you think that PIMCO was always a seller? What did it look like? What would happen in those markets?
So they did a few things that I saw. More or less directly, we would see them using 5, 10, and 30-year futures as a long, to add duration risk to their portfolio. And by being long the futures, you're synthetically short options, right?
Okay.
Because of delivery switches and
right. Okay.
And,
yes, that's correct.
Convexity changes, right? Then, in addition to that, they would go into like the bond pit and just every quarter just start raining options. All sorts of calls, puts, straddles, strangles,
and just selling, right? That guy, he just, every time I saw him, I remember one time he talked about the Boone trade being the trade of his life, like a short trade of his life. This is when he moved on to Janus. And I remember at the same time going, this is great. This is a terrific short. I agreed with him. I thought the timing made sense. And the Boone went from minus 30 basis points to 40 to positive. Like it went 70 basis points. And he ended up having to come, holding his head down saying, well, I ended up losing money because I was short a whole bunch of puts as well. And I was like, dude, you're talking about this being the short of your life and somehow you're still gotten yourself into trouble. Like you couldn't resist selling some cheap puts.
It's very hard for a guy that's worked at one place for a zillion years. They have a culture in place. They have risk management skills. It's not his money. He's getting the paycheck. Then he goes and he starts a new fund, which is probably a lot of his money, which is, I'm sure, as you know, because that's what you do, right? You trade your own money. That's a lot different. People tell you it's not. It is.
But he still sold so much vol. I just don't understand it. But anyways, okay, so give us a color. Like, so you know, when we were talking earlier, you mentioned swaptions. Why don't you tell people about like the swaptions market? What are like the tools of the trade in the institutional kind of fixed income world that we aren't aware of, and how do they work?
Well, so you had talked about the Eurodollar futures, right?
Yeah.
And so basically, that is sort of an equivalent of a Eurodollar swap.
Right. Okay.
So instead of XYZ company wanting to get short a 3-year in Eurodollar futures equivalent, they would just call up a bank and say, I want to pay on a 3-year swap, which means you're paying a fixed rate and you receive a floating rate. So the fixed rate is fixed for the duration of the term of the swap, though in this case, like a 3-year. And then you would pick either a 3-month or a 6-month reset. So it would be just like selling a 3-year note where you short it and then you go in and you borrow it and cover the short, and the overnight rate floats to cover your short position. So there's this interbank market, the swap market, which I just mentioned, and it mimics the Eurodollars. So there's all sorts of products guys will trade against those, which the biggest one I think where you're interested in is swaptions,
Right.
which is just a fancy word for an option on a swap.
Right.
And those things trade like water. So to kind of square the circle, PIMCO would routinely come in and just sell huge amounts of volatility to take the premium in to their fund, and that was one of the ways that they enhanced the yield,
enhanced returns, right?
Right.
And then typically, though, a lot of these big hedge funds on the other side that are rates traders, they will do the opposite. They will only be long volatility. Is that not correct?
Well, one of the guys who's sort of the biggest in the business has got likes to do these things. It's him and an ex-colleague of his who's got his own fund now. These guys traffic in these things, and they're very bright guys. And the nice thing about looking at the Eurodollar contracts versus a swap is for average Joes, if they want to look at what the 3-month rate is 4 years from now, you just look at the Eurodollar contract.
Yep.
You know, the 12th one out or something like that.
Yeah.
And so the banks will run these Eurodollar futures against the swap curve, and if it gets too far out of line, they'll just
arbit, right?
back
Okay,
and
yeah.
forth, right?
Right.
But they're taking the aggregate of the Eurodollar curve. So if a couple are a little higher and a couple a little lower, they're not really going to care because they're just looking for what we call the strip yield.
Okay, I get it. Yeah, right.
And so if you know, if Pete and Repeat decide that 4th year is too cheap, they're going to call. They're either going to go into the pit.
Yep.
And they're going to say, you know, where's the 9,900 call?
Yeah.
And the guy's going to say it's 4-bid at 5, and say, okay, I'll take 100,000, and he'll get them.
And it's crazy, isn't it? The size, like the liquidity on those things is just unbelievable.
Yeah. I mean, I've personally had 30 or 40,000 of those options.
Come on, really?
Well, yeah, because it would be like, you know, one tick would be, you know, 500, 600, 700 grand, and well,
Yeah, no, I get it. I understand. You toss around big numbers, and that's what it is. But it's a great market. It's a great market, though. Like, you know, and I've recently, we were talking about it earlier before the show about how these options that are on the mid curve, they call them mid curve options,
Yeah.
which makes no sense. I don't understand why they call them mid curve.
Yeah.
But in essence, I'll try to explain it just real quickly.
Please.
When you go and let's just say you have an euro dollar that's 4 years out, and you pull up the options on it, you're getting a 4-year option. But what you really want is like a 1 year or even like an 180-day option on that 4-year, farther out contract. And for some reason, they call these mid curve. And figuring out how to trade them is just, it's the second most difficult, biggest mystery in the world. And I'll let you guys figure out the first. So once you finally get the quote, it's hard to find. And it's dark, but anyways, no. And you finally get the quote, and you're just like, "Wow, I wish I'd known about this." But it really is difficult. And I would really I've kind of stumbled upon these things, and I'm thinking to myself, there's a reason all these hedge fund guys are using this. They're great products to trade, and I'm excited as hell about them. And I'm going to go start modeling them up. I've got my spreadsheet going. I'm going to start. I don't know if I'm going to be repeat, but I am going to start trading these things because I think it's a great opportunity.
I got good news and bad news for you.
Okay.
The good news is you're onto something. The bad news is the real jing in these things is when the curve is steep, right?
Right.
So we're at a very, I know you're not a rates guy, but a steep yield curve, you get roll down.
Yeah,
right?
no, I understand. Yeah. You know what? I listen as an institutional equity derivative trader. We had a big book, and we would do it on the real short end, because we would do it in our swap book. We would actually have swaps, and we would hedge them, and then not only that, we would do it against our futures and things like that. So I do understand carry, and I do understand I always think I laugh when I meet bond traders because I've never met a bond trader who doesn't just love being long because it's the carry. They're always long, right? Because there's a inherent carry into it.
It's sort of like the hedge fund manager that runs a long only equity portfolio.
Right. Because over the long run it works, right?
Yeah. That's probably a better setup than being a bond trader. But but anyway, back to these mid curve things. I do think that's the secret sauce because it's a longer discussion, but when you get into steep yield curves,
right,
you can get some very interesting carry and roll down dynamics, such that you can buy an option in an unchanged environment in 6 months. Your option makes money, so you've got positive roll, positive carry, and then if you're lucky enough, and rates were to decline in a call in this instance, you get that as well. And that was one of the things we used to try and run in the book as a hedge, right? Because if you're long, something bad in the world happens, the front end rallies.
I have a feeling that trade is going to be replaced with something else. So listen, let's imagine you're a young person today, that loves the market, super interested, loves hearing your stories about all these different things. What advice would you give him or her?
Well, I guess what I'm starting to see as I get a little bit older is, I think what I try and ask them to think about is, where do you want to end up?
Well, let's say they wanted to replicate your life. They want to be a successful, veteran Wall Street trader sitting in Greenwich enjoying themselves.
God, I think that's really hard these days.
Do you? You don't think it can be you don't? Yeah.
Well, so here's one of the things, for instance, I think works against the young people. Okay. So I went to University of Illinois, and I have a master's degree in accounting from the University of Illinois, and my grades suck. I mean, this was just terrible. Well, nobody would hire me, yet I had a pretty good knack for this thing. So that's one of the things. Secondly, because of the way they've gotten the regulations and the front office, back office infrastructure in place.
Right.
So when I started in the business, you had a rigorous training in the whole business.
Okay.
Front office, middle office, back office. And a lot of the things I learned about how to make money were because I understood how all those pieces got put together.
Ah, interesting.
And so you talked about delivering securities, right? About, because you weren't stoned. So you got
that's right. Way back. I started originally, I was a bond messenger. You're absolutely right. In high school.
Yeah. So there would be things like if you sold some bonds to the Fed, for instance.
Yep.
Okay. Well, most people don't know this, but you don't have to have them. You can borrow them. I mean, so you borrow them, and then you got 30 days, but you got to deliver something else. And so there's all these little gimmicks in here that
you could make money on.
Yeah.
I don't know. Okay, well, I'm going to take the other side of your trade. I'll fade you, Morris. I'm going to say that there's things happening. I would encourage people to go learn technology. I'd go learn how to go program, do stuff that the old guys can't do, that they are sitting there wondering how to do this. Worry about, look at new technology. Even though I hate Bitcoin, let's face it, there's some guys who made themselves fortunes in this stupid thing. And I think it's ridiculous. Like I use the word redonkulous. I think if there was ever a word, ever a security that should be used for that word, it's Bitcoin. But people made it. So I always just say, be passionate, go learn as much as you can, figure out what your edge is. I think your edge as a young person is technology. That is
So if I may, I think obviously you're right, but you hit something earlier that I think for you would have been a better answer, which is you talked about the understanding the human behavior, which creates the alpha, right? So instead of typing away in a computer, maybe trying to understand how people behave in different environments under different stresses.
Well, I think that's great advice. I completely agree. I think that is one of the things that you look at markets and you see them repeat, and there's nothing new. Like, you've just given us the best lesson ever. You pulled up a book, which, by the way, Taylor has found, and so it is online as a PDF. And we'll make sure we include it in our daily kind of send out of the email. But you can actually get this book from 1688, Confusion to Confusion. No, I don't know how to say it. Yeah. Joseph de la Vega. Oh, look, he even has a great name. He even has a great last name, Vega.
Vega, yeah. I found it in the original Portuguese to be better than the translation.
But, okay. You're a strict. You like the strictest things.
I'm just kidding.
Okay, so listen, we're gonna call this interview there, but you're sticking around, right? You're gonna give me a hand with the rest of the show.
If you don't mind.
Listen, I think it's gonna be great, and thank you very much for sharing your words of wisdom with us. And let's get to it. Okay, Morris, it's time for no stupid questions, just stupid answers. And of course, the stupid answers won't be coming from you; they'll be coming from me. So Lena hops on now, because we always like hearing Lena read these. Much better voice than all of us. Lena.
Okay, so the first question is a two-part question. So this listener writes, I know what inflation is. I think I know what deflation is. What on earth are disinflation and stagflation? And are there any other types of inflation I don't know about? Second part of the question. Kevin?
Oh, wait. Can we do the first one first? Can we tackle the first one?
Of course. Go ahead.
Okay. So inflation, I guess you can, is the general rise of prices. Is that correct, Morris? I guess it's pretty easy. There's different people have different interpretations, but it's generally considered the general rise of prices. Deflation is the opposite. It would be the falling of prices. And disinflation is the slowing of the rate of inflation, meaning that if you have inflation of 5% one year and then 4% the next year and then 3% the next year. And then finally, stagflation is high inflation with limited economic growth and maybe even contraction. So that's why it's stagflation, because we actually have a situation where prices are rising, but the economy is not doing well and in fact could be falling. Do you think I got it?
I think so. the question, are there other types of inflation?
Yeah.
I wish I had seen this earlier because there's got to be a joke in there somewhere.
Yeah, I
just
know.
don't
I
have it yet.
don't know. I don't have any other kinds of inflation either. Why don't we do this? I'm sure that our listeners will have much better jokes than any of us. So send us in the other kinds of inflation that you might know about. Okay, Lena, let's read the next the next section, please.
So the second part of this question is, Kevin, in MMT, fiscal stimulus is only bounded by inflation. Do you think governments will have the balls to put the brakes on when fiscal stimulus finally does cause inflation?
No. And another no. And, even though I say that, I still think it's the right policy to take. And I've said it numerous times. I'll say it one last time. We as human beings abuse whatever their system we're going to do. And in the past, we've done monetarism and we've taken it to extremes. And I think all you have to do is look at Europe to see that we have negative rates. And if that's not an abomination, I don't know what is. And that's monetarism taken too far. And MMT will be taken too far. And I know all the MMT folks will tell me, oh no, we're going to put in these automatic stabilizers and they're going to be able to stop it. And I just call BS on that. I think that we're going to get inflation and it's going to surprise everyone to the upside, and it will be very, very difficult to slow it down. Having said that, I still think they should do it. How about you, Morris? What do you think?
It's kind of trying to get the genie back in the bottle. I just don't see, once they start giving people money, they're not going to be able to rein it back in.
So here's a question for you. Is the genie already out of the bottle? And if we wanted to put it in, is there a chance that we get a return of, let's say, the deficit hawks, the tea parties, and we actually go back?
No. Like, I had this discussion with the missus last night, and I tried to say, forget about Republicans, forget about Democrats. By my calculation, $1 trillion gets us where we need to be. Okay. So you got 1.8 bid at 2.2, and they can't even come to some agreement. And so,
so your argument is that really what we need is $1 trillion here just to kind of do what's needed in terms of getting us through the hump. Yes. And they can't do that because they're already bid through the real amount. So your argument is the genie, like Elvis has left the building.
That's right. Yes.
Okay, Lena, how about you? Let's. What about the next one?
So the second listener's question is, first of all, thank you for an always great show. A quick, stupid question. Why is it Patrick and Kevin continue to be so bearish on the Canadian dollar while they're bullish on commodities and energy? Or is that just because of signature Canadian humbleness?
Well, I'm not sure about that signature Canadian humbleness because we like to brag a lot as Canadians in terms of our hockey players and our bobsledding teams and things of that nature. So there are things that we are very proud of. But in terms of the actual, why are we so bearish on the Canadian dollar? First of all, Patrick is always a US dollar bull. So you have to take anything Patrick says with a huge grain of salt because the guy always thinks the US dollar is going up. So therefore, he thinks the Canadian dollar is going down. As for me, I am probably too bearish on the Canadian dollar, considering that I am somewhat sympathetic to the energy trade. And I think that a lot of times there is something like a home court pessimism, I would call it, that when you see the problems up close, you're more likely to kind of think they're a bigger deal than not. And, I write about, I think I was bearish on the Canadian dollar, and my buddy Louis Gave, he writes a great piece, and he's from what's the name of his thing? Louis
Gavecal?
Yeah, Gavecal. I don't know how to say it, but anyways, terrific guy. He's moved to Canada, and he's like, "You're too bearish. Like, the commodities are going up. It's just don't be dumb. Like the Canadian dollar is going up." So, Morris, what do you think about the Canadian dollar? Is it going up?
It seems pretty cheap here to me. I haven't looked recently. Maybe but Western Canada Select.
Yeah, we can look it up. Let me just have a look here.
I think that would be
Bloomberg.
I mean, for people listening at home, that's a Canadian crummy quality crude oil, right?
Yeah, It's crummy.
Well,
Well,
I
all
mean,
Canadian
it
crude
just,
oil is crummy. Yeah, no, it's oil sands crude oil, I believe. I think that they actually, it's so thick they have to mix it with real oil to get it to flow through the pipes.
how much is that trading a barrel?
It's $32. So it's still at a $10 discount too.
Yeah, but it was down around a couple of dollars at one point.
Yeah, I think it actually went negative in the spot market too as well.
Yeah, so I guess the $10 still rich.
Listen, we are, we like to shoot ourselves in the foot about our energy policy all the time. But I don't know how to say this, but you're almost you're almost a Canadian. You're coming up to visit us. I'm surprised, first of all, that we're letting you in.
Well, there's some rules.
Yeah, there's lots of rules.
We have to be there for 15 days.
Yep. So why don't you tell people why you're coming up?
My eldest daughter lives in Regina.
That's right. So he's wisely coming in October. Yes. And only Canadians will get that joke. But anyways.
So we have to come for 15 days. Yeah. We can't leave the property. And there's something about 8 hours a day of break and rock, but I think that was I don't think they're serious about that.
When we went, it's not only is it that we do that to you guys as Americans coming up to Canada, we do that to ourselves within the provinces. I have a couple of daughters that go to school out in the Maritimes, and when we went out there this summer, we had to do the same thing. We had to isolate for 2 weeks. And not only that, they phoned us every single day to make sure we were following through. They're serious about it.
There's a $750,000 Canadian dollar fine, right?
Yeah, that's like $3,500 though in US.
Yeah. So we're supposed to quarantine when we come back here to the States.
Yeah,
which it's $1,000 fine, and you get your name in the paper. So I've already told my wife, I said, "Don't fucking kid yourself." Excuse my.
No, it's okay. No worries. No worries. So you're going to Regina. You've been before.
Yeah. Oh yeah.
I know. My question for you is: have you ever been in the winter?
Oh, I've been there. This is a fun fact. I've been there at a time when the temperature in Fahrenheit and Celsius is the same.
Yeah, the convergence at the lower end.
They're wonderful. They're wonderful people. Honest to God, nice. They're the nicest people in the world, especially when you come from Greenwich.
So I'm actually from Winnipeg, and I'll give you a quick story about how cold it can get there. So my father, I grew up, and he was a research director for one of the securities firms in Winnipeg. And at the time, the provinces were doing a lot of borrowing. So they would get up these big, huge Wall Street bigwigs to come so that they could float their bonds. So this fellow comes up, and it's cold. It's a bitter, January day. And he comes up there, and he is not dressed for it. He has no idea how cold it's going to be. So he comes to the Richardson building, which is, one of two towers in Winnipeg. And he goes up, he makes his presentation, and then my dad says, okay, we got to get you to the other side. We got to get you to the building across the way. And my dad says, let me call you a cab. And the guy says, cab? It's like, isn't that it? Like across the way? And my dad goes, yeah, that's it. But he says, it's cold. And the guy says, no, forget it. Let's just do it. So they run across, okay? And he's this big guy from Wall Street, and he's not dressed for this, and he's smoking a cigar as he's doing this. So they run across, they huff to the other side. They get to the other side, and he says, see, it wasn't that bad. And as he's saying that, he takes the cigar out of his mouth, but in the meantime, it's frozen to his lip, and it actually pulls off a big chunk of his lip with it.
Welcome to Canada.
That's right. That's how cold it was. It's cold enough that your cigar freezes to your mouth as you're running across the street. That's how cold. Now, Lena, I didn't give you a chance to do the final part here.
If you have any questions for Kevin and Patrick, submit your questions to nostupidquestions@markethuddle.com.
Great. Well, thanks, Lena. Okay, Morris, I've been looking forward to this a long time. This is skin in the game. Let me just grab my rules because I need to tell everyone about this. And Morris, you are here for my first loss, by the way. Let me just see what I lost for the first time. I said last week, I said, will the euro currency tick at a new high for the year next week? And Hearst Kupperman, our buddy Cuppy, he voted on behalf of Patrick. He said, no, it wouldn't, which is good because that's what Patrick would have chosen, and I lost. So now, let me just read the rules. Skin in the Game is a weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager. The other guy chooses which side of the bet he wants. Every wager needs to settle by the next episode, and the currency for the wagers is as follows. Let me just get it up here. A Duke and Duke, which is $1. Then it goes up to a pint of beer, a burger bet, a pitcher, a case of beer, which is a 2-4 for us Canadians, a bottle of wine with a $100 limit, but there should really be a minimum for Patrick. And there, a steak dinner is the biggest one. Okay, the winner of the bet is obligated to create a new bet for the following week. Okay, now we're going to do it slightly different because I lost here. And we want Patrick to have a chance. Now this is the important part, and you'll appreciate this, Morris. All wagers settle in full, and there will be no netting of positions.
Huh.
This is like 2008 great financial crisis. There'll be no netting of positions.
Okay.
So that means
that
so when Patrick and I have if there's 6 cases of beer and then 3, we don't net it out to a net 3. It's 6. We deliver 6 and then 3. Okay, so what we've done now is we've let Morris come up with the bet for me. So Morris has to present me with something, and then I get to pick which side of the bet I want to be on. I do not know what he's going to do. He has asked me if it's allowed to be complicated, so I am a little worried about it. But let's see what he's got.
Well,
Morris.
Okay. So, I feel a little bit like I've got a little flexibility because this is my 3rd time. So I feel like I can
Push
have
things?
a little fun with
Yeah,
it.
smart at Huddle for sure.
And of course, Lean is there to edit anything that you don't like. So I never realized you considered yourself an inveterate gambler, which actually makes this more interesting. So when I first moved to New York and had some money in my pocket, I used to gamble on football.
Okay.
And there's a reason I'm giving you this explanation, so just bear with me. So there was a bet with the bookies called the teaser.
Okay.
Are you familiar with this bet?
No, I'm not. I am not a big sports guy, so I don't bet a lot of sports.
So basically, you picked 2 games, okay?
Yeah.
And you any 2 games you want, and you got the spread, but you had to win both games. And if you won both games, it paid 4-1.
Okay.
So this is my prop bet to you. Okay. I'm going to give you 2 market levels.
Okay.
And if you got to take over under on both of them, and if you're right on both, I pay you 4-1. And if you're wrong on either of them, you pay me 1. So it'd be you pay me a Duke or I pay you a pitcher.
Okay. Sounds good.
You with me so far?
I'm with you. So let's do it.
Okay.
What do you got?
Okay. So I'm looking at the NASDAQ futures, the NQZ zeros.
Okay. So we're Canadian, so this NQZ0, but yeah, I'm with you.
Okay. And so my level over under is 11,500.
Okay.
So you're going to have to pick the over under on that.
Okay. Do I get to? I want to hear the whole bet before I tell you which one I want to choose.
Okay. And the second bet is the VIX.
Okay.
And
cash, or are we doing fuge?
I just typed VIX.
Okay, that's cash. Okay, that's cash then. Okay, yeah.
Okay.
I'm with you.
And that level is 28.
That's tricky.
Yeah, I actually thought a little bit about this one.
It's tricky. So I got to give you both over, under, and they can be different. So I can tell you under on the NASDAQ, but over on the VIX.
Which is what one might think you might want to do.
Right. Okay. But
Which is why I jobbed you to the downside.
And so wait, is it closing on Friday, or are these one touch?
No, they're closes.
Oh, they're closes.
Yeah.
Oh, well, okay.
And I will even give you ties.
Oh, you're
Okay.
very kind.
Well, I mean, you never know.
You never
never
know.
know.
Okay, you're like, it's like in Vegas when the ties go to the client, right? Okay. Oh man. So, that is tricky because I could see it's still VIX going up. Yeah, I see why you did this. It's tricky. I like it. I like it a lot. Okay, I'm going over on the over on the Nasdaq, under on the VIX. I'm doing it straight. I'm doing it straight. I'm gonna assume that we get a risk on, and I'm worried about my VIX though. Like I feel like we could get a situation where market rallies and the VIX I still lose on that. Like I think it was a really good bet because I think you got me, and I'm not prepared on 28 to go with the over. But if it had been 27, I would have chosen over on the VIX because I think VIX will be really close, and I think that if I get hurt, it's probably going to be on that. Anyways, that's a great bet. Thank you very much, Morris. I appreciate that.
I'm excited. Thank you for the offer to think of something challenging because otherwise, what fun is it?
Yeah, no, that is awesome. Okay, so everyone, thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow at the Market Huddle. We're on Twitter every day. Give Lena a shout out. She gets tired of talking to Patrick and myself. You can listen to the Market Huddle on all networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content. And please, if you could, rate us on iTunes. It's a dumb game, but it makes a difference to Apple's algorithms, and it helps us out immensely. Morris, do you want anyone to know where you can find you? You're not on Twitter or anything like that, are you? You don't want anyone actually contacting you, do you? No.
Twitter? No. Thank you, though.
Okay.
Thanks.
Well, I am at Kevin Muir on Twitter, or you can check out my newsletter at themacrotourist.substack.com. And listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show. Okay. Lena, Taylor, Morris. This is going to be fun. Now, Morris, this is where the magic really happens. Okay. At this point, only the real diehard listeners are listening. And we talk about everything but the markets. So first, I got to rate the beer. So I'm just going to quickly do this. Bear Hug IPA, I'm a big fan. I'm going to give it an 8-1. It's a solid beer. Someone should go and figure out what I gave it last time to see how inconsistent my rating is.
Do they sponsor you guys, or you just go to the store and buy these things?
No, of course they send them to us. We wouldn't just go to the store and buy them. Okay, so wait, we wanted to talk about something. What did we want to save for the after hours, Lena?
The bacon.
Bacon, that's right. Okay, so first of all,
you got to put
bacon.
that picture up there.
Yeah. I love bacon, and I wanted to ask you guys something. Tell me something that bacon doesn't make better. I have one thing, but that's it.
I don't know.
Think about it.
It's true.
It goes almost on. So ice cream is my only one that I've decided that I don't think it makes ice cream better.
I'm sure it's good with chocolate ice cream.
You think?
Yeah. Have you ever had chocolate-covered bacon?
No. Yes, I have.
It's like meat.
So I'll tell you, I have my wife's sister's husband is from way up north, not that far up north. Basically, where Taylor is right now. And they have what they call the Bacon Eaters Club, and they go away for a long weekend, the Labor Day long weekend, and they eat nothing but bacon.
Oh wow, my arteries.
That sounds awful.
What do you mean?
That sounds terrible.
Really?
Yeah, I have like bacon with my breakfast. Like we're in the middle of the country, so we have all these great butchers. So I went to a butcher, bought like 4 pounds of bacon, made 3 of them for my whole family, and then I had like 8 pieces, and I was like, this is enough for the next while. A whole weekend of bacon?
I don't know. I think it's good. What do you think, Morris? Chime in.
I haven't had bacon in a long time.
You're one of those healthy guys, aren't you?
Not exactly. It's sort of like my tribe frowns on pork, but I just found after years of eating it, I feel better not eating it, and I think it was kind of God getting the message across to me. I'll tell you what, the bacon smells fucking great.
Yeah, it really
can't get away from it.
Morris, I'll tell you something. It tastes even better. So
it's moment on the lips, lifetime on the hips.
Oh, there you go. Lena's got all the lines. So Morris, you're a big biker, right? Like, so when I cracked myself up mountain biking, you were like, you started telling me about yourself. Why don't you, so are you a road biker and a mountain biker?
Yeah. So years ago, I went out riding with a buddy of mine who was a pretty good cyclist, and like a half hour into the ride, I'm like on the side of the road crying for mercy, and I came back and said to my wife, I've never been so physically humiliated in my life. So this was 2003. So I signed up for that Chris Carmichael training system. It was.
I don't know it. Chris is this a Greenwich thing? This is a fancy Greenwich thing?
No, it was an internet cycling thing that Lance Armstrong was involved with.
Oh, I didn't know.
So,
okay.
Anyway, I got really fit and did some road racing and a lot of club rides. And, I was a very, very, very mediocre racer and a decent club rider.
Okay.
But what happens is when you get older, you get more physical limitations because of heart rate and stuff like that, VO2 max. So a number of years ago, I thought I'd try something new. So I picked up the mountain biking.
Okay.
And, when you get at my age, you don't want to fall. So I'm not really good with the technical stuff, but the endurance thing is pretty good. So I started doing these long events. The big one is this thing called the Leadville 100.
Okay.
Which is it's in Leadville, Colorado. It's 104 miles with 12,000 feet of elevation gain. 12,000
feet? Holy shit.
Yeah.
Is it up and down or just up?
Well, 12,000 feet up and down.
Oh,
and
do you end up? Oh, I see what you're saying. Okay, you end up at the same place, or you end up at the same elevation?
It's like 52 out, 52 back.
Okay.
And to get the buckle, the belt buckle, you got to do it in under 12 hours. And if you're in over 13, they pull you off the course.
Okay.
So I did this first time 3 years ago.
Yeah.
And like I said, I just picked up mountain biking, and I did it in 12 hours and 50 minutes or something like that.
Oh, so you didn't get kicked off, which is...
I didn't get kicked off the course, 48 years old, yada, yada, yada.
Yeah.
But I'm like, fuck, I got to be able to do this, right? So I threw
You wanted the buckle. You wanted the buckle.
I wanted the fucking buckle. And so you're going to... I think this is hysterical. So I'm training like mad. And, they have, like everything else now, they have a computer program that if you put in your variables, it'll tell you what your time is. Right?
Okay.
So I said to the guy I was working with, I expect my race weight to be 150 pounds.
Okay.
If I got my weight down to 147, how much time would I save? And he came back and he said, it'd save you 4 minutes. And I'm like, 4 minutes over 12 hours? You realize the probability of that making any difference is zero, right? Okay. So guess what? 12 hours, 0 minutes, 46 seconds.
Oh.
And this took like 46 fucking minutes. There was a picture of me crossing the line that somebody put up on Reddit.
Yeah.
And the quote was like, what happened with this guy? He took him to the hospital.
That is heartbreaking. So are you going back to do it, or are you done? Like, was that it?
I was signed up to do it this year, and then they got the COVID thing.
So how many laps of this thing do you do?
Well, it's out and back. It's 52 miles out, 52 back.
Holy smokes! Oh, I see this. I'm googling it as you speak. There's some guys going down already, and there's other guys walking their bike up.
Yeah, it's so the pros will do it in like 7 hours.
Oh my God!
And the great amateurs will do it in like 9 hours.
Yeah.
And so, if I were 30, adjusted for age, I'd probably be at like 10 and a half hours.
Right. But that's like you get up at 8 in the morning and you go till 8 at night?
You get up at like 4 in the morning, you eat something, you try and get yourself to use the bathroom.
Yeah.
Then you drive an hour.
Yeah.
It's 30
So what time does it start? Does it
6 a.m., I think.
Okay. Wow.
Now, just to save face, there's another event 2 weeks earlier called the Leadville Stage Race.
Yeah.
They cut up into 3 sections, so they do 1 section a day, and you need to do that in, I think, 10 and a half hours or 11 hours in aggregate, and I did get the buckle on that.
Oh, good for you. Listen, I'm impressed. I suspect that almost we're joking about not getting the buckle, but I suspect that most people would get absolutely smushed, and you obviously worked really hard to get there. So now, did you go? Have you gone? Do you go? I went for the first time downhill, I went up on a chairlift and went down, which I feel like my son was ecstatic about this. I feel like this is cheating. This is just not right. It felt like it was something wrong. Have you gone and done this stuff? Like, are you jumping? Like when they have these rollers and stuff, are you getting there and stuff?
No, but what I have thought of doing is doing that chairlift and then coming down to work on my descending skills.
Right. Okay. Yeah.
Because you can blow on a 15-mile descent. You can lose 10 or 15 minutes by being a shitty descender.
Right. And just not being comfortable on the bike or whatever, right?
Yeah.
So do you run 27.5-inch wheels or 29s?
29s.
Oh, okay.
29. That's sort of the standard now for the cross country stuff.
Oh, okay.
But these bikes are all fucking tricked out. Like I have just one chain ring in the front.
Right.
I got a 50 in the back. So it's like a 50-10.
Okay. Right.
And everything's electronic, including a dropper seat post.
Yeah. So my son has a bike like that. I don't. I have an old school bike, but yeah. Well, that's wild. That's good for you. That's awesome. Do you enjoy the mountain biking more than the road biking?
Yeah. And the interesting thing is, it's a much nicer community, the mountain bikers.
Oh, okay.
But just in a very general sense, the road bike guys tend to be more dickish.
Right. So it's like that. Well, as you say, they tend to be more dickish. It reminds me of that story about Dan Loeb and Bill Ackman. Do you remember? Did you ever read that?
Which one?
The story about Dan Loeb and Bill Ackman.
Yeah. They wanted to do like a bike race.
Well, they went out just riding, and then Bill Ackman couldn't stand being not the alpha at the front, and so he ran up to the front and went for a while, and then I don't know, started cramping up and was just a disaster. Like what's it called when you guys
honking or something?
Yeah, it's something like that. And
so the Bill Ackman thing's funny, if I may interject.
Yeah, for sure.
So I know Bill a little bit, and I was working on a project with him and another buddy of mine. The buddy of mine's a biker. So, as you have said, Bill's a very competitive guy.
Yeah, okay, yeah.
So I was telling my buddy, we got to find a way to kind of snooker him. Because, you see me here, right? I mean, I'm just kind of like a little Jewish guy. But, watts per kilogram, that kind of thing.
Well, yeah, the best bikers are little guys. They're not big.
That's the thing. Plus, I'm a little bit older, right?
Yeah.
So we were trying to find a way to bamboozle Billy but he's a smart guy. So we weren't. And by the way, I got to tell you something. you talk about people's public persona
Yeah.
and their private. So, he had this whole thing going on with the multi-level marketing.
Right. Yeah, that's right. When Herbalife, when he was trying to short sell.
Herbalife, yeah.
So he's on TV talking about how he short the thing and it's a fraud. And so you can appreciate, for me being a trader, like the last thing I'm telling anybody about is me being short something.
Yeah, that's right.
Right? Because they're just going to fucking squeeze the shit out of it.
Yeah, that's
right? And I'm thinking, God, Bill, what a chucklehead. And, the funny thing is, like, I've been in some business deals with the guy. There is not a finer gentleman. There is not a better partner. There's not a more
that's good to know.
guy.
Oh, that's good to know.
It's just so funny because I relish the fact that I have gotten to know him 2%.
Yeah.
Right? But, you see the way people are in public and this sort of Mr. Hedge Fund manager. And then when you actually work with him.
Oh, well, that's good to know. It's better, it's better that than the other way when you see a guy and he pretends to be all nice and then he's a complete dick in private.
Well, I've had that.
We won't name any names on that.
I've had that.
Well, it's good to know Bill is a good guy. Maybe I'll reach out to him for my next project.
Yeah, just tell him Mo sent you.
Yeah, there we go.
So we're sitting. Can I tell one more thing?
Yeah, for sure. These are great stories. Yeah, I love them.
So one of these projects didn't go so good. And so there's probably 10 of us in a room. I can't believe I'm telling you this. Anyway, one of these deals didn't go so good.
Yeah.
And so Bill's there and two other guys. One guy who had been Bill's roommate at like Harvard Business School.
Okay.
And another analyst who had been at Harvard Business School. And so, like I said, there's 10, 12 guys in a room, and it's tense because the deal's not going right. And, you can tell already. I just kind of take the piss on stuff.
That's right.
So
Blurt it out.
I look across the room, and I said, how many Harvard MBAs does it take to fuck up a deal? And everyone looked around, and they look at me, and I said, 3. True story. True story.
No, that is a great story, Mark.
I feel like we have to bring Morris back for like his own
For
segment.
sure.
Morris's stories. He's got always great stories.
Sweetie, I got a lot of stuff to talk about.
Yeah, you'll like hold a flashlight under your chin. It'll be called Morris Stories.
Oh, that is good. Okay, so you know what? I don't know if we're going to be able to top that, so we're going to leave it on that. So, Morris, have a great, safe trip. Enjoy yourself in Canada. Enjoy yourself isolating in Regina. There's not a nicer place to do that. And I hope you enjoy your time with your family. I'm glad that we let you in because family is important and it's very difficult in this time. And so I'm glad you figured it out, and I'm glad that. What did you phone up Justin himself? Like I figured your Rolodex, you probably said, "I'm going to phone up Trudeau and get."
I have to be careful because where I'm going to be staying, they're not a big Justin fan.
Oh my God! Listen. I understand that as a Winnipegger that's growing up, the Westerners do not enjoy Justin, and they do not think much of his dad either. Like sometime you should ask your daughter or your daughter's husband the history of that, because it actually goes back just past. It's not just Justin; it's also his dad. It's a long.
His mom was kind of a wild gal too.
Yes,
right?
his mom was wild, but his dad was hated out west, and it's something called the National Energy Program, and it's many Canadians have not forgotten him, and that's why actually I think it's flabbergasting that he's not more sympathetic to the Western kind of plight, and he's screwing up that. But anyways, you know what? I am truly a Westerner at heart, so I side with my Albertan and Saskatchewan and Manitoba brothers and sisters, and I am with them that I am disappointed in Justin's energy policy. But we'll just leave it at that. Have a safe flight and enjoy yourself. And thank you so much for sticking around.
Nice to chat with you guys.
Terrific.
And look forward to seeing you again sometime, hopefully.
Thanks again. Take care.